Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Opendoor Technologies.
If you find our talks useful, please consider subscribe, like, and comment underneath. And before we jump into the real meat of things today, I want to quickly mention StockOracle. It's an AI-aided stock research platform we use to, kind of help frame our discussions.
Yeah, and you can actually find a special 14-day trial link right below in the description.
Just a quick heads up, that is an affiliate link, meaning the channel might earn a commission at no extra cost to you. And remember, StockOracle's AI insights and valuation estimates, well, they can be incomplete or wrong. So always verify the important facts yourself.
Yeah.
It's not financial advice, right?
Right, exactly. So getting into Opendoor Technologies.
Imagine building this incredibly high-tech machine to flip houses at lightning speed, right? But then you realize that for every single dollar you generate, you're effectively losing almost 47 cents.
Wow, yeah, that is just a brutal metric.
It really is. I mean, you're physically moving homes, carrying these massive mortgages, and just bleeding cash on an industrial scale.
And from a wealth-building perspective, this is such a crucial context for investors to grasp. It's the classic tension between survival and scale. We're looking at this algorithmic real estate model, the whole iBuyer concept.
Right, which was supposed to completely revolutionize how we buy and sell homes.
Exactly. But right now, it is really fighting to just keep its head above water in a very unforgiving environment. It really shows why you can't just look at top-line revenue when you're assessing a company for your long-term portfolio.
Yeah, you really have to look under the hood. So today, we are going to dissect the actual underlying fundamentals, the rather intense financial engineering they are doing to keep the lights on, and, this deeply polarized market sentiment.
Because if they are losing that much on every dollar, that cash obviously has to come from somewhere.
Right. And looking at the first half of 2026, the underlying business engine is flashing some severe warning lights.
Oh, absolutely. The sheer magnitude of the revenue drop in the fundamentals is just staggering.
Yeah, I mean, they pulled in about $1.6 billion in the first half of this year.
Yeah.
Which, sounds massive, until you realize that in the exact same 6-month period last year, they generated $2.72 billion.
Right. They basically watched over $1 billion in revenue just vanish year over year. That's a 50% drop.
Which is wild.
It is. And the scarier part is how quickly that top-line bleed flows straight through to the margins. Because with the iBuyer model, you are dealing with high-ticket items.
Right. Selling one house pads your revenue by hundreds of thousands of dollars.
Exactly. But it's the margin, the actual profit after you pay for the house, the renovations, the holding costs, that actually dictates whether the business survives. Currently, their trailing 12-month gross margin is sitting at an incredibly thin 8.6%.
Wow, just 8.6%. That feels structurally dangerous. I mean, think about the last time you did a home renovation, or even just hired a contractor for something small.
Oh, it always goes over budget.
Always. If a supply chain issue delays your materials, or a house just sits on the market for an extra 2 months because interest rates ticked up, you are still paying property taxes.
Yeah, you're paying insurance, HOA fees, maintenance.
Exactly. If your gross margin is only 8% to begin with, a few bad weeks of carrying costs just wipe out the entire profit of that house.
You've hit on the exact mechanism of the iBuyer vulnerability right there. It is fundamentally a volume game. This model requires massive, predictable scale to offset those razor-thin margins.
Right, because when your revenue suddenly drops by 50%, your fixed overhead doesn't just magically drop by 50% with it.
No, it doesn't. You still have to pay the data scientists, the corporate salaries, the software infrastructure. Those fixed costs remain, and they absolutely crush the bottom line.
Which explains why their net losses are widening so aggressively. They posted a net loss of $335 million in the first half of 2026.
And just a year prior, that loss was $114 million, so it's getting worse fast.
Yeah, in the second quarter alone, they missed consensus revenue estimates, hitting $83 million versus the expected $900 million, and took a $162 million net loss.
And mathematically, that brings us right back to that staggering trailing 12-month net margin of negative 46.7%. For every dollar coming through the door over the last year, they are losing almost half of it. It's a systemic bleed.
But here's the massive disconnect that I am really struggling with when we look at the catalysts. Despite these dismal trailing numbers, management is publicly guiding for 20% or more year-over-year revenue growth for the upcoming third quarter.
Yeah, that's their big promise.
And on top of that, they are reiterating this goal of achieving adjusted net income profitability on a 12-month forward basis by the end of 2026. How can they realistically project a 20% jump in revenue and promise a path to profitability when they just lost $1 billion in top-line revenue?
Well, it requires the market to believe in a absolutely flawless execution pivot. Management is effectively arguing that the backward-looking data reflects the old Opendoor.
You mean the houses they bought under looser underwriting standards?
Exactly. The ones they had to sell at a loss just to clear the books. They are betting that the houses they are buying today, using tighter algorithms and better cost controls, will sell at much better margins in the third and fourth quarters.
So they're saying the worst of the inventory right-sizing is basically behind them.
That is their argument, yes. But they are asking the market to trust this horizon line while the ground they are standing on is literally crumbling.
Right.
It's an enormous leap of faith for investors. And that Q3 earnings release, which should drop around November 2026, that's the ultimate test, the main catalyst.
Right. Hitting that 20% growth target is the primary measurable early signal of stabilization we need to watch for. If they miss that, the entire profitability narrative just falls apart, right?
Exactly. The whole adjusted net income goal is definitely viewed by many as aspirational and unverified right now. It all hinges on a perfect Q3.
So with all that riding on the future, how are the technicals looking right now? I imagine the market is pretty skeptical.
Oh, extreme skepticism. The technical indicators perfectly reflect a massive institutional flight. As of mid-August, the stock closed at $3.64.
Wow, so that's a roughly 66.5% drop from its 52-week high of $10.87.
Yeah, it's trading significantly below its 20-day, 50-day, and 200-day simple moving averages. For context, the 200-day moving average is sitting way up at $5.39.
Which is essentially a line in the sand for long-term investors.
Right.
And Opendoor is trading at a massive 32.5% discount to it.
Right. When an asset trades that far below its 200-day moving average, it confirms that the market is entirely focused on the downside risk. The short and medium-term trends are undeniably negative. It's down over 26% just in the last 6 months alone.
Even the momentum gauges reflect this fatigue, right? Like looking at the relative strength index, the RSI, it's sitting around 44.7.
Yeah, and for those who don't stare at charts all day, an RSI of 44.7 basically means the stock is sluggish and drifting downward.
Right, it hasn't even hit the point of maximum irrational panic yet. It's just this slow, steady bleed.
And that sluggishness is mirrored perfectly in the highly polarized sentiment among the analyst community. You have a fascinating tug-of-war happening right now between the bears and the bulls, all looking at the exact same data.
It is incredibly divided. I mean, the overall sentiment leans bearish to neutral. UBS came out and slashed their price target down to $4.50, maintaining a neutral rating.
And meanwhile, you have research pieces out there taking an outright bearish stance, pointing directly at the deep second quarter losses and weak transaction volumes.
Right. And crucially, citing evidence that Opendoor's house renovations are currently running over budget and behind schedule.
Which loops right back to our earlier point about that 8% gross margin.
Exactly. If your margin is that thin, a renovation running 2 weeks behind schedule completely destroys the profit on that unit. It kind of validates the fear that their algorithmic pricing models just cannot adequately account for real-world friction.
Yeah, the bears are entirely focused on this execution risk. They are evaluating the company based on what it is physically doing right now, which is struggling.
But then, right in the middle of all this bearishness, you get a completely contrary take. JP Morgan steps in with a surprisingly constructive outlook.
Yeah, they stated that Opendoor's door to profitability is cracking open, citing improving fundamentals and momentum toward that year-end milestone.
Just how do analysts at JP Morgan look at billions in liabilities, shrinking revenue, and over-budget renovations and conclude that the door to profitability is opening?
Because they're playing a completely different game with the data. The bulls are looking strictly at the trajectory and the forward guidance. They're basically taking management at their word.
So they're assuming the worst of the news is already baked into that 66% drop, and any slight improvement will cause the stock to violently re-rate upward.
Precisely. It comes down to what you weight more heavily, the proven messy reality of today or the promised horizon of tomorrow.
Which brings us to arguably the most urgent part of the bear case, the risks. If they are bleeding out 37 cents on the dollar, how are they actually funding this turnaround attempt?
Right, the liquidity issue. Operating cash flow took a brutal hit. It swung from a positive $544 million in the first half of 2025 to a deeply negative $964 million in the first half of 2026.
We are talking about nearly $1 billion in negative operating cash flow, while total liabilities have jumped to over $2 billion by June 30th.
We do need to unpack that negative 964 million, though, because in this specific business model, operating cash flow can be slightly counterintuitive.
How so?
Well, Opendoor is fundamentally an asset-heavy buyer. When they purchase a home to sell later, that purchase counts as inventory, and it is deducted from their operating cash flow.
Okay, so a massive negative number might just mean they are aggressively buying up inventory that holds real physical value.
Correct. Inventory movements completely dominate their cash flow statement. But your point still stands. Houses are illiquid. You cannot pay your corporate payroll or service your debt with a spare bedroom.
You need actual cash liquidity. And clearly, Opendoor recognized they were running out of that runway. On August 13th, they announced a major capital overhaul, and the mechanics of it were just fascinating.
Well, it's a very complex move.
They're offering $650 million in 0% convertible senior notes due in 2030, designed to add about $440 million in new growth capital. But at the exact same time, they're using roughly $158 million of that cash to repurchase 45.3 million of their own shares.
Yeah, at a reference price of $3.49 per share.
Wait, I have to challenge this logic. They're taking on $650 million in new debt, but using a huge chunk of it to buy back their own stock while their operations are bleeding cash. Isn't that like taking out a new mortgage just to buy your own living room furniture?
It looks completely contradictory on the surface, I agree. Why enrich existing shareholders when you desperately need capital? But when you break down the mechanics of a convertible note, the strategy makes sense, even though it introduces severe leverage risks.
Walk us through that mechanism.
So a convertible note acts like debt initially, but the lender has the option to convert that debt into equity, meaning shares of Opendoor at a later date, in this case, 2030. Because the lender gets that potential upside, Opendoor was able to negotiate a 0% interest rate.
Which means no immediate monthly cash interest payments, protecting their strained cash flow.
Precisely. But there is a huge catch. If the stock does well and those lenders convert their notes into equity in 2030, they will flood the market with millions of new shares. That drastically dilutes the value of every existing share.
So the simultaneous share repurchase buying back those 45.3 million shares right now is a preemptive strike.
Exactly. They are proactively shrinking the number of shares on the market today to offset the massive dilution that will happen when those notes convert in the future.
Okay, I see the financial engineering behind it. But zooming out, the bear case is still blaring here. They are layering on highly complex debt just to engineer their way through a rough patch. If you are an investor looking at your portfolio, this level of balance sheet gymnastics has to make you nervous.
It absolutely does. The institutional market is currently demanding hard proof before assigning real value. They have built the e-commerce machine, but now they have to prove the software can survive the physical realities of the housing market.
So to wrap this all up into a final verdict, the overall bullish score or rating we're looking at here is a 3, which carries a bearish stance. And again, this isn't us telling you to buy or sell. We never do that.
Right. We were just looking at the data, explaining the upside of a potential successful pivot and the very real downside risk of massive dilution and continued cash burn.
Exactly. So my final provocative thought for everyone listening. If an algorithm-driven, massive-scale real estate model struggles this heavily with basic renovations, minor inventory delays, and cash flow during fairly typical market fluctuations, does the entire iBuyer model have a structural flaw?
That is the big question, isn't it? What happens to a business holding over $2 billion in liabilities if the U.S. housing market were to enter a prolonged deep freeze?
Something to keep in mind as we watch how this Q3 earnings report plays out over the long term. And hey, before we sign off, I want to remind you to check out that link below for the special 14-day trial of StockOracle.
It's a great AI-aided stock research platform to help frame your own research. Just remember to verify the facts, as AI insights aren't foolproof.
Absolutely. Thank you so much for joining us. Don't forget to subscribe, and we'll catch you next time on Smart Wealth.